Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis with a new week of Money Talk on Monday the 17th of June. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business, economic and finance headlines, the Bank of Japan left its overnight interest rate unchanged at 0 to 0.1% as expected in its latest monetary policy meeting Friday. The vote was unanimous, but policymakers at the Japanese central bank surprised markets by voting to continue their current asset purchases until the July 30th and 31st meeting, despite BOJ Governor Ueda's earlier indications that a reduction in the bond buying programs may be due. The central bank will come up with a plan for reducing its 6 trillion yen worth of monthly bond purchases over the coming 1 to 2 years at their next meeting. New bank lending in China rebounded far less than expected in May, and some key money gauges hit record lows, suggesting the world's second largest economy continued to face headwinds. Chinese banks extended 950 billion renminbi, that's about $131 billion in new yuan loans in May. That was up from 730 billion in April, but well below economists' estimates of 1.3 trillion. Meanwhile, total social financing, which is a broad measure of credit and liquidity in the economy, rose to just over 2 trillion renminbi. Outstanding yuan loan growth came in at 9.3%. That's a record low. Consumer sentiment in the US unexpectedly declined in June as the near-term outlook for inflation held at its highest level since November 23. The University of Michigan's survey of consumers showed a preliminary reading of 65.6 on the sentiment gauge, down from 69.1 in May and below economists' expectations. On inflation, the one-year outlook held at 3.3%, while the 5-year view nudged up from 3% to 3.1%, also its highest level since November. French stocks tumbled on Friday as the prospect of a far-right government and left-wing opposition rattled European financial markets, deepening a sell-off that's wiped 150 billion euros off of Paris's main index. The CAC 40 Friday closed 2.7% lower and has now erased all its gains for the year. The risk premium on France's debts continued to surge on Friday. The gap between benchmark French and German yields rose to 77 basis points. That's the highest since 2017. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and Nitin Dialdas, Chief Investment Officer at Mandarin Capital. And providing a view from Mainland China will be Yanan Wu, the Chairman and CEO of Surfin Group. And if you have any questions or comments about the show, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Friday, US stocks were mixed. The Nasdaq Composite ticked higher to close at a record for the 5th straight session, despite more than 70% of the index closing lower on the day. The tech-heavy index rose by 0.1% to end at 17,689. The S&P 500 inched lower by less than 0.1%, closing at 5,432 and snapping a 4-day win streak. And the Dow slipped 58 points, or 0.1%, to end at 38,589. Hopes for a continued cooling of inflation boosted the S&P 500 and Nasdaq last week. The S&P 500 ended the week higher by 1.6%. The Nasdaq Composite was up 3.2%. The Dow was off 0.5% over the 5 sessions. The yield on the US 10-year Treasury note declined for a 4th consecutive session to 4.22% on Friday. Over the week, the 10-year yield is 21 basis points lower, while the 2-year yield has fallen 18 basis points to 4.71%. That's the lowest level since April the 4th. The dollar was firmer on Friday, supported by weakness in the euro, after French Finance Minister Bruno Le Maire sparked a rout in European assets after he answered yes when asked if the current political crisis could result in a financial crisis. The euro ended the session 0.4% lower at $1.07, down 1% for the week. The Japanese yen ended the session 0.2% lower at 157.37 against the dollar. The offshore yuan weakened to around 7.27 renminbi per dollar. That's close to its lowest level in 2 months. Gold was up 1.2% Friday to $2,333 an ounce for a weekly gain of 1.7%. Bitcoin was down over 1% Friday and 5% over the week to just above $66,000. And Hong Kong equities dropped on Friday. The Hang Seng Index shed 171 points, or 0.9%, to 17,942. For the week, the index was down 2.3%. Chow Tai Fook, one of the world's largest jewellers, led declines in the Hang Seng, falling almost 9% after rising gold prices led to unrealised losses of 2.5 billion Hong Kong dollars. That's about $320 million as a result of short positions the company used in gold as a hedge against its holdings of large amounts of the precious metal. On the mainland, the Shanghai Composite rose 0.1% to 3,033. The index was down 0.6% for the week, the fifth straight week of losses. And the Hang Seng projected to open about 150 points lower this morning, starting the day just below 17,800 mark. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us Alex Wong, Director at Alex KY Wong Asset Management. Morning, Alex.
Hi, morning.
And also with us is Nitin Dialdas, who's the Chief Investment Officer at Mandarin Capital. Morning to you, Nitin.
Good morning.
Let's start in Japan. The Bank of Japan left its overnight interest rate unchanged at 0 to 0.1%, as expected in its latest monetary policy meeting Friday. The vote was unanimous, but policymakers at the Japanese Central Bank surprised markets by voting to continue with their current asset purchases until the next meeting, which is on July the 30th and 31st. That's despite BOJ Governor Ueda's earlier indications that a reduction in the bond buying programme may be due. The central bank's going to come up with a plan for reducing its 6 trillion yen of monthly bond purchases. That's about $38 billion, and it's going to reduce them over the coming 1 to 2 years and come up with a plan at the next meeting. And ahead of the next meeting, the BOJ said it's going to collect views from market participants and will decide on the detailed plan then. Alex, this is going to be a slow, gradual process, isn't it, reducing this ultra-loose monetary policy?
Yeah, I think it will be a very slow process. And I think the market already discounted that. And the benefit of a weak yen actually is now getting smaller and smaller, because I think if you look at the exports, I think the competitions from the money inflow actually from Taiwan and Korea now. So I think Japan is actually losing a little bit market share in the global money, and then the local actually are suffering from the low yen. And actually, I think people are concerning about the risk of stagflation in Japan now.
And corporate CEOs are speaking out more and more, aren't they, about the dangers of the weak yen? They're not so comfortable anymore with the yen at this level.
Yeah, because the benefit actually is getting smaller, and the risk actually is getting bigger. So I think people are a little bit concerned about this weak yen policy.
Listen, from a market perspective, what does this mean? Particularly, what does it mean for the yen? Are we going to see the yen slide further?
Yeah, I think the yen will start sliding back towards 160 or go even beyond that now. Going back to what Alex was saying, I think if you look at the Japanese economy, it has slowed down quite considerably after last year's little bit of a pickup. And I think that's the biggest concern. And while if you're outside of the tourism sector or the manufacturing sector, there is absolutely no benefit of having a weak yen. On the contrary, you're importing inflation. There's a whole number of factors that come in on that. You're having to pay higher wages. I mean, they've announced, over 5% wage increase. All of those hit the bottom line of a company. Now, if you're not in that tourism sector and the manufacturing sector that is benefiting from the weak yen, you're struggling, and that's just going to carry through into what goes on in the markets.
Has the Bank of Japan missed the boat here? There was a time last year, wasn't there, where the economy was stronger and it could have started raising rates, tightening monetary policy then. It's now sort of seems to be forced into the position where it's tightening monetary policy when the economy is weaker and weakening.
Yeah, and I would have actually liked them to have done that, because at the end of the day, there's Japanese are net savers. So had they started increasing rates and maybe providing something back for those, that have savings, would that might have translated into them spending more on the economy, and therefore you would have got a more broader range recovery as opposed to just in those sectors that I mentioned earlier. So I would have actually liked them to try that, just to see what whether people will feel more comfortable, start spending on their interest that they're getting on their savings. They don't necessarily have to diminish the savings, but even like a little bit of a gain, that's still a little bit more of a sort of spending on the economy, and whether that started seeing things pick up. So in answer to your question, yeah, for sure, I think they did miss a boat, yeah.
What do you think, Alex? Have they left it a bit too late, aren't they? Because they're in the position now where they're tightening, or being forced to tighten, when the economy's down almost 2% quarter on quarter.
Yeah, I think there's a risk, and probably they should take a risk to tighten anyway, because the weekend actually is bringing not much benefit now, and then probably a surge in yen would help a little bit on many things. So I think probably they would still need to do a rate hike late soon.
This is an impossible position, isn't it, for the Bank of Japan? It owns so much of the JGB market. Well, it owns, I think, more than half of it, doesn't it? That how on earth does it get out of this? How on earth does it unwind that massive balance sheet?
Oh, I don't know, actually. This is just like the US, actually. They still got a so massive balance sheet everywhere. So this is very difficult to imagine the unwinding.
Just keep kicking the can down the road. Isn't that what they always do?
They're sort of running out of road, aren't they? The problem is, for the Japanese government, the cost of the debt servicing is just going to go higher and higher, same as for the US government.
Yeah, for sure. And like Alex, I have no idea how they get out of it. I don't know what they end up doing. But at some point, the pain needs to be taken, and it's a question of when.
OK, let's turn to the Chinese economy. We had some loan data over the weekend, or so Friday we had some loan data. New bank lending in China rebounded far less than expected in May. Chinese banks extended 950 billion renminbi, that's about $131 billion in new yuan loans in May, up from 730 in April, well below their economists' estimates of 1.3 trillion. Total social financing, which is a measure of credit and liquidity in the economy, rose to 2.07 trillion. And for the first 5 months of the year, data from the central bank showed a total of 11.14 trillion in new yuan loans. M2 money supply rose by 7% from a year earlier. That was also below April's figure, also less than estimates. And outstanding yuan loan growth came in at 9.3%, a record low, and down from 9.6% in April, also below what analysts were expecting. It doesn't seem, Alex, that this is great news, is it? This loan data, it seems to just be pointing to how weak the economy is.
Yeah, I think it's difficult to lend out right now because property market is slow. So and collateral actually is a little bit dangerous now. So it's quite difficult for them to lend aggressively. And then I think the only bright spot recently is the manufacturing sector in China actually showing some resilience. But I think if you lend too much out, probably would lead to the worsening of the overproduction capacity situation.
There was a really sharp contrast, wasn't there, between exports and imports. Exports jumped 7.6% year on year in May. Imports, though, just 1.8%. Again, sort of seems to be pointing to the weak domestic demand.
Yeah, right. So the domestic market actually is weak because I think the property market actually is spilling over to other sectors. So recently we have a very bearish sentiment towards the consumer sectors in China, and I think that probably will still affect the local demand.
Can consumer confidence get better without the property sector recovering? Is it possible, or are the two so linked that it just can't happen?
I think it's quite difficult right now. I think the job market actually is difficult to recover because we have so many sectors getting affected by this. And then also, I think the education sector is also affected. So there's quite a lot of holes to fill. So I think it's not easy to boost up the employment.
What's your thoughts on first of all the loan data and Nitin?
Yeah, it is weak. Consumers as a whole, they just don't want to do anything in China at the moment. There's no confidence in the economy, and it's all bearing out. And you're seeing that with the loan data. You've seen that in terms of even the imports. And I think it's a long, long way to go. Apart from just looking at it from a property sector is overspilling. There's been a number of sectors, a number of industries that have been affected over the last 4 or 5 years, and it doesn't come back overnight. I mean, Alex mentioned the education sector, but anything in the private side got decimated, and that's a massive part of an economy. And telling people, okay, now we want to support private companies is fine, but when you've had 5 years or 4 years of destructing them, you can't just turn around and go, okay, now we're going to support you. People are just not going to believe you right away. So that's going to take a long time to come back, which drives a lot of the job growth that could potentially happen. So if you're a citizen of China at the moment, and you're being told go out and spend, you're not going to go and spend because you just have no confidence at all in what your future holds.
And a lot of your wealth is tied up in property.
And a lot of your wealth is tied up in property, and a lot of that movement from getting yourself out of that lower end to the middle, high middle class and all was based on the fact that property prices were going up and moving from the rural areas into cities. None of that's happening anymore. I mean, they've built so much property all over all these cities that people just aren't moving to because, again, there's no confidence. One, they'll get a job. Two, property, even if you get it, what's the prospects? It's probably going to go down. So you're better off sticking with status quo and then just going, look, at least I know what I've got here.
What does China do this week, Alex, on interest rates? Does it cut them, or is it too difficult at the moment with the week you're on to go and cut rates?
Well, I think they would keep the monetary a little bit loose, but they probably may not be too aggressive in the policies. I think the yuan probably was still a concern. But of course, I think if the US dollar getting supported, I think they do not mind the yuan going a little bit lower at a slow pace.
We got a lot of data today, haven't we, with the industrial production, retail sales, fixed asset investments, the unemployment rate. So we're going to get a good picture today of how the last month was looking. What are you expecting?
I think we need to look at the retail sales very closely. I think recently people are very bearish towards the consumer sector in China because multi actually are getting a price cut, and I think people are very concerned about that because that is probably the most resilient commodity in China. So I think people are very concerned about that, and we need to see how the retail market can perform.
Nitin, what do you think about, first of all, interest rates? The PBOC is going to fix interest rates on Thursday. Any opportunity to cut, or will it make any difference if they do?
I don't know if they will cut. I mean, there is an opportunity to cut, but I'm not sure if they will actually go ahead. Do they need to? They probably do, but I think China's now quite concerned over anything they do will have a reaction globally. And I think they've got to be very, very careful. Now, if they cut rates, they start weakening the yuan, with all this anti-dumping stuff that's going on in China, and in Europe and the US, they're going to fuel that even more. And they know the US and Europe are going to start berating them for doing something. But, to me, they should be strong, and they should say, you know what, Europe, the US, say whatever the hell you want. Mm-hmm. But at the end of the day, our domestic economy needs this, and we've got to do this and look at this from an actual overall economic health. Whether they do that, I'm not sure. We'll find out, I guess.
Okay, let's turn our attention to the US. We had data also from there on Friday. The University of Michigan's survey of consumers showed a reading of 65.6. That's down quite a lot from 69.1 in May, also well below economists' expectations. It's the lowest reading since November, and over the 3-month period there's been the biggest drop in consumer sentiment since the COVID lockdowns. So Alex, this is another, first of all, I suppose it's another signal for the Fed, isn't it, to maybe think about easing rates? Yeah,
I think US actually is slowing down across the board, and I think consumer actually is sentiment is weak because we have already feeling the accumulative inflation impact, because that 3% actually compounded several years already now. So there's a quite huge accumulative increase. So I think that's why consumer sentiment is getting worse. And also I think people are now feeling the job market actually getting a bit worse now.
And they still seem to be a bit negative about inflation. The one-year outlook for inflation held at 3.3%. The 5-year moved up a bit from 3% to 3.1%. So sort of also maybe a little bit of a whiff of stagflation there.
Yeah, I think this is a psychological impact because you have seen the inflation to be so sticky for quite a few years, so your expectation actually built in. So I think that's a lagging indicator, so probably that could change quite fast.
Do you think this influences, Nitin, the Fed's thinking here, the weak consumer sentiments in terms of when to start cutting interest rates, or is it just one piece of data and maybe not enough?
No, I think it's one piece of data and not enough. And I think one of the interesting things about the States is you look at the consumer sentiment and it's very, very inflation driven. So it's based on the fact that they do feel inflation is going to stay high, and that's what's driving the sentiment. But one thing I disagree with Alex, actually the job numbers and the job employment situation, US has been actually continuously been strong. If you look at the number of job layoffs, they're at the lowest levels they've been in a number of years. Jobs growth last week was much better than expected, and jobs have actually, the employment situation's actually held up very, very well. So I think when you take the overall picture on that side, the Fed has no reason to lower rates. Then you look at the economic growth; it's still in the twos. It's pretty decent. Everything they look at, inflation still remains over 3.3, 3.4%, still well above that 2%. So no matter what they look at, it's no reason for them to actually lower interest rates at this point. What I do find interesting, though, is I think it's a two-tier economy. Now, anything in the larger sector, whether it's large cap techs, some of the bigger companies out there, they're doing phenomenally well. The lower end, the smaller mum and pup kind of shops, or even if you look at it in terms of the stock market, the small caps, those are the ones who have been suffering on the inflation. So it's a very difficult situation for the Fed, because who do you support, or what side do you go? Because take the top half and it's all looking very, very rosy. The bottom half is now starting to show some strains, and do you start supporting that bottom half, or do you continue just taking the overall picture and say, well, actually overall we're still pretty healthy, we don't need to do anything? And I think they'll take the latter.
Okay, let's turn our attention to the markets. A lot going on last week. I want to start in Europe. A big sell-off in European assets last week, and particularly on Friday in French stocks and French bonds. It came about after French Finance Minister Bruno Le Maire said yes when asked if the current political crisis could result in a financial crisis. That prompted a 2.6% fall for the CAC 40, the French index, on Friday. And it's now erased all its gains for the year. Alex, how much do we need to be watching this? I mean, a financial crisis, that sounds pretty scary.
I think we need to watch it closely, because right now probably that would raise the concern on politics impact on the market overall, because we have already got Mexico and India earlier. And then this time we got France. So I think that people probably would feel the impact of a political situation on the market. So that is one thing that could spill over. And then probably we need to see whether policies in Europe actually would change. So I think that is quite concerning.
The problem is, we don't know what their spending plans are, but all we do know is the socialist bloc and probably the far right have got rather big ones.
Yeah, so that's why I think the bond market reacts first, and then people that spill over to the stock market.
Could that affect markets here?
Affect market here probably not. I think in China actually it has its own path, I think. Yeah.
Nitin, there's a lot of political issues around at the moment, isn't there? But we've got two big elections now coming up in France and the UK. Maybe the French one is even more important than the UK one here.
Yeah, I think the French one, because it was so unexpected, has thrown a bit of a spanner in the works. The UK one's pretty predictable. Labour's going to win. Everyone's kind of already foreseen that. And now you just go, okay, what Labour policies will transpire? And Keir Starmer is kind of conservative light, a bit like Tony Blair. So I'm not so sure it's going to be pure Labour as a system. And I think that the market's quite comfortable with that and quite happy to have that, certainly for the next 5 years. In France, it's a mess. I mean, quite simply, it is a complete mess over there. How that then spills over, obviously, if you've got political instability, that could translate into weaker economies. There's a whole number of factors out there. Obviously, they're very far right. So France becomes a lot more of a difficult equation, and that's the one I think that does concern a lot of people.
And we could end up in the situation where in France, Emmanuel Macron's centrist party is pretty well wiped out. And in the UK, the Conservatives, they could get wiped out as well by Reform UK stealing a lot of their votes. And as a result, Labour wins in a huge landslide.
Yeah, do they win in a landslide? I think they win in terms of overall numbers, but Reform and Conservative Party split the votes. That doesn't necessarily equate to a Labour landslide, but obviously you don't have a strong opposition party anymore. So you don't, I mean, given the fact that you've got Reform and Conservatives taking half and half of their votes, collectively they won't be so far behind Labour, but at the end of the day, Labour will win and Labour will come in. I'm not convinced it'll be a landslide, but I do think Conservatives and Reforms will get a few more votes than people are predicting. But overall, I do think Labour will come in, yeah.
OK, let's turn our attention, Alex, to the markets around over here. The Hang Seng down 2.3%. Over the week. On the mainland, the Shanghai Composite down 0.6% for the week, the fifth straight week of losses now. This rebound is definitely run out of steam, hasn't it?
Yeah, I think the concern is on the consumer sector right now, because last week we got very heavy selling in the retailers in Hong Kong. So I think people are very concerned about the consumer market in China, and that is quite concerning to me as well. I think the overall driver actually is consumer, so there's a very big question mark now.
Well, I'm wondering why now, though, because we've known for ages, haven't we, the consumer sector has been weak. Why the sudden, maybe the renewed sell-off in consumer stocks?
I think Multi actually led the way. It is the biggest one, and it broke below all supports last week, and so that spilling over to other things.
It was down almost 2% at one stage. The report was its products were selling at a lower retail price on the mainland, which presumably is a sign that the conditions there are cooling even further.
Yeah, and I think that also signaled the problem on the high-end spending in China. So also I think you got heavy selling in companies in Europe as well, like Hermes actually down quite a lot recently.
Okay, well, we'll get on to the Alex Index in a moment. Nitin, let me just get your thoughts first of all on Hong Kong and mainland China stocks.
Yeah, I think the initial boost was over Chinese New Year. It looked like consumers were starting to feel a little bit more positive, so that transpired into the markets where people were hoping that would be a longer term trend. But it seemed it was just a one-off in terms of what has been a longer-term trend of negativity. And then last week, or a couple of weeks ago when we had the Dragon Boat, I mean, the spending was considerably lower than what they expected, and that's really hit the markets hard. So, I don't know, just in terms of China, you really do need those consumers to start feeling more confident. How do you get that? It's a long road. I mean, they're trying to keep saying that they want to support, as I said earlier, the private side. They're trying to, get the youth unemployment down, but it's a long road, especially with the policies that are there, and especially over the lack of trust that's been built up over the last 5 years, or lack of confidence. And until you really see a sustainable recovery across industries, rather than just say the one manufacturing industry, I think China is, it's going to be tough for it to come back for now. But over the long term, it's still quite positive, believe it or not.
OK, well, Alex, let's talk about the Alex Index. Just as a reminder for listeners, this was a basket of companies that Alex recommended about 9 months ago now, back in September 2023, that was going to outperform in what were going to be difficult markets. It started off containing HSBC, China Mobile and CNOOC. We added also China Resources Power later on. So far, has it outperformed? Well, the performance since September 2023 is that basket, which I put into an index for Alex, we call it the Alex Index, is up almost 31%, 30.7% in fact. And the Hang Seng over the same period is down 1.3%. So that's almost over a 32% outperformance. So far, going very well. I have to ask you, though, are you now tempted at all to take profits on any of these?
No, I don't think so. I think the bigger story in Hong Kong is insurers in China actually are relocating more of their bets towards those safer equities. So I think that's why we are seeing those big caps actually benefiting from this fund flow. And they are also asked to raise their dividend. So I think that's also another bullish factor. And I think the weakness in other parts of the market actually would drive the money more concentrated. So that's why I think these few counters actually would continue to perform.
So these are really defensive, safe stocks, good dividends, all the things that you want in a bear market.
Yeah, in the meantime, probably HSBC may lose the momentum, but I think it's still okay to hold on. Right?
Okay, and we're going to add a new stock, aren't we? We've reconstituted the index. We're going to add another company, so it's going to now become 5 stocks. Well, what's it going to be? That
will be Jijin 2899, because I am quite bullish on the long-term prospects of copper. And I think gold price actually would remain firm as well. And so Jijing actually has been a very excellent performer in the last decade. It actually is make a new high this year. I think this is a neglected long-term outperformance in Hong Kong. And then recently it has corrected because people are a little bit concerned about the trend of copper because that is still quite sensitive. I mean, the demand actually are getting slower when the copper prices get higher. But I think the long-term structural demand actually would surge because of the AI. So I think this is a good time to buy on this current short-term correction.
Okay, so we've added that now at the close. We'll put that into the basket and we'll see how it does. Nitin, let me get your thoughts on the US markets. Are you getting worried at all about these markets? Because they're at all-time highs, but on narrower and narrower basis, 70% of the Nasdaq was down on Friday, but yet it still hit a new all-time high. The Magnificent Seven has become the terrific three now. It's really just down to three stocks, isn't it? Microsoft, Apple and Nvidia, which are all both around $3.2 trillion worth of market cap. They're just fighting each other each day to see which one can be the slightly bigger one.
Yeah, I mean, to be fair, the last 2 years, last 18 months, has actually been all about large caps anyway. I mean, you look at the small, as I said earlier, you look at the small cap index, it's really done nothing. So it has been very much a large cap driven index or performance in terms of the US. Am I getting worried? Yes, I am. I think it is very overvalued. And funnily enough, when you asked Alex a question earlier about whether France's problems will then translate into the Asian markets or in Hong Kong, China, I actually think if you get a sell-off in the US, you get a sell-off in Europe, it actually starts benefiting Asia because that money's got to go somewhere. And Asia is very cheap in comparison, China and Hong Kong in particular. So I think you will start seeing some of that money come flowing back into this side once you get that sell-off. The question is, when does that sell-off happen? I don't think it happens over the summer. I think it probably happens later in the year. But I am starting to get pretty concerned over more the valuations than anything else. Having said that, Nvidia at say 50 times PE, it's not outrageous. You know, it's not crazy. It's growing tremendously fast. So those large caps can still run a little bit. I just think for the rest of the market, it's going to continue to underperform, and you've got to be very, very selective in where you play the US now.
What's interesting is the amount of money sitting in money market funds has hit another new record. $6.12 trillion now sitting in money market funds, which I suppose first of all suggests that maybe people think interest rates aren't going to come down that fast and taking advantage of these high rates. But also at some point that money could go into the markets, into the equity markets.
They could, but like you said, if you're getting 5% on the money market funds, it's a pretty healthy return. And it's better than the majority of the dividends you're going to get in a lot of stocks out there, and it's safe. So why would you not play it? Why would you not take that as opposed to playing a value stock in terms of trying to be defensive in part of your portfolio? The growth part of your portfolio is performing well. What do you do on your defensive side? Take 5%. It makes sense. So I think that's more a reflection of the fact that interest rates are high and people are quite confident they're going to stay at those levels for a while, and let the large cap growth stocks perform on your return side, and you stabilise your portfolio with the 5% out of the money markets. No need to play value stocks at that, right?
Alex, are you concerned about how narrow this rally is now?
Yeah, of course, I think this is a big concern because right now this is getting more and more concentrated, and I think people are now focusing more on the need of AI than the need of people. So people are now trying to bet on things which would benefit from the surge of AI only, I think. So that's why the behavior is also polarized right now. And people actually are not too concerned about the monetization of an AI model right now. So there's a big concern in the long run.
Well, thank you. Have a great week. You heard that Alex Wong, who is director of Alex KY Wong Asset Management, and Nitin Dialdas, who's chief investment officer at Mandarin Capital. I'm joined now by Yanan Wu, who is the chairman and CEO of Surfin Group, headquartered in Singapore. Morning, Yanan.
Good morning, Peter. How are you this morning?
I'm very well, thank you, in hot and sticky Hong Kong. Let me ask you about the tariffs that the EU has imposed now on Chinese EV imports. They could be as much as 48% when you take into account the existing 10% levy, and then some other companies could get an extra 38% of tariffs. What is this going to do for the Chinese EV makers?
Yes, Peter. This is the background of the so-called new trio that comprised of EV, lithium in batteries, and photovoltaic products. It has been, the new trio of exports from China, and that indeed has gained so much market share during the last 5-6 years. So if you take EV, for example, since 2016, the production of Chinese EV has been continuously in number one in the world. In 2023 alone, the new EV industry has even seen exponential growth. The production and the sales have reached respectively 9.6 million, and also 9.5 million. So that's the weight of the global production has reached over 66%. And since 23, and the Chinese automobile industry exports has surpassed Japan, become the largest auto export country in the world. So I think that's in this background we can see the EU has taken this new tariff. Of course, hopefully the so-called overcapacity and also the pricing in competition can be elevated in Europe. But I have to say, relatively speaking, the EU take a more mild approach compared to the US. It's more like a de-risking for EU to be not to be too monopolized by Chinese EV industry, rather than decoupling, taken by the US side. So that's why if you take the tariff the percentage, the levies is actually relatively more mild. Even it's 48% for some of the other automobiles, but if you look at the BYD, it's only 17.4%. Geely is 20%, and that's why you look at the stock price of BYD right after the announcement by EU tariff, it's actually gained 8% in terms of stock pricing. So on one hand, it's more pricey for Chinese EV in the EU market, but on the other hand, it actually give a clear road plan for how Chinese EV industry will penetrate further for EU market. So that's more certainty than uncertainty after this EU tariff announcement. Of course, yeah.
How do you think President Xi will respond to this? Will China be cautious, do you think, in their response? Or is there a risk that we could just have an all-out trade war between Europe and China?
Yes, of course. There's already some response from the State Development and Reform Commission about this tariff announcement. Of course, Chinese has to warn EU side that it's such a tariff on one side policy probably didn't help European automobile industry, especially EV industry, because ultimately it has to increase. Europe has to increase its own competency and also the production chain, for the whole Europe. So just simply by increasing the tariff, it doesn't not increase the competency of the EU industry in France or Germany. Of course, the argument was, there's also the subsidies from Chinese government and on the consumers for the past 10 years. That's just ended 2022. For example, the EU EV car automobile price has subsidized about more than $8,000, and some local government still even have a 10,000 rebate back for the consumers. And for the past few years, the EU EV charging piles has also increased dramatically, after China, the government subsidies. And, right now China has more than 6 million, charging piles in the whole country.
So how much economic pain are these tariffs going to cause China? Because China, it has about $3.4 trillion of exports a year. About 500 billion each goes to the EU and the US. So significant amounts of exports to both those markets. But then at the same time, it's notable, isn't it, that China's exports to the ASEAN economies are increasing quite fast. So it seems to be increasing its exports to other markets outside of the US and the EU. So what sort of difference will this make economically to China?
Yes, indeed. I think it's not a one-sided action. China also probably have this, replan the global export diversification, like just mentioned, rather than, because in EU, Europe, the Chinese EV exports more than half of its whole EV export. So now China has to think about how to diversify the EV exports rather than relying upon European market, but also expanding to more ASEAN market and other emerging markets. For example, in the past 4 months this year so far, the Chinese EV export to Brazil has reached 450,000, and that's already 8 times of last year-on-year level. So that shows the new so-called new trail that's including EV, lithium battery and photovoltaic products has now expanded to more emerging markets. And Europe is interested in taking similar actions rather than relying on Chinese production chain. Its own global gateway map has expanded to India, Indonesia, so that the new renewable energy industry production chain can have a similar production chain in these 2 countries. So I think it will be interesting to see the ASEAN region and also the India now become the biggest consumer markets, and will be more competitive between China and Europe, and likely probably from US as well. So I think diversification, it definitely is on the agenda for Chinese exports for this new trail.
Now, we're going to get a lot of data today on the Chinese economy for the last month. We've got in retail sales, industrial production, fixed asset investments, also unemployment data as well. We had bank loan data out on Friday, which showed loans rose less than expected. Chinese banks extended about 950 billion renminbi in May. That was well below estimates of 1.3 trillion. What's it telling us about the state of the Chinese economy?
Yes, so the social financing data and also the money supply data did show that the government is leveraging up. And however, enterprises and housing holds are actually deleveraging. So that's what you can interpret from this May social financing numbers, and also the money supply, the month-on-month increase. So if you look at the May social financing numbers, it did increase, about 2 trillion. That has turned around April's negative increase. Among the 2 trillion, the loans contribute about 800 billion, but the government bonds financing has increased 1.2 trillion RMB. So indeed, the government contributes the major part of the May social financing number. But if you look at year on year, the household new loan level has actually decreased about 300 billion compared to last year, the same months. And if you combine the April and May number, the social financing of household actually decreased, reduced by 600 billion compared to last year level. So indeed, household, however, has not increased the loan demand. Especially on house property real estate market, even though this new stimulus policy, but actually more and more property market has not been revived yet, and the household has fewer demand to buy new property, real estate, actually pay back the mortgage. If you look at the enterprise side, even though the notes of the enterprise loans has increased, but the short-term loans has decreased 20 billion compared to last year in May, and the 2 months negative increase has increased to 400 billion for short-term loans, and the mid-term, long-term loans has decreased 250 billion compared to last year. So enterprise indeed also deleveraging. So if you include both short-term and mid-term, long-term loan, in both April and May has decreased about 1 trillion RMB compared to year last year. So that's a really demand issue from the housing and also household and also the enterprise level. So how to revive the demand from these two sectors are very critical, for the government policy, especially the fiscal policies. So rather than just purely relying on government bonds and government spending.
Let me finally ask you about Yanan, the G7. G7 leaders that were meeting in Italy over the weekend have issued their starkest warning yet to China over its support for Russia. It's accused Beijing of enabling Russia's war in Ukraine, and it's threatening more sanctions if Beijing continues to provide critical support to Russia during the war. How big a concern should this be?
This I think is a warning signal that from the G7, represented by the U.S. efforts in the background. So far, it's the small banks has been warned about this swift cutting off risk because of if there's any involvement with Russians funding through these channels. So that's an initial warning signal. But if you look at the last month, the G7 finance meeting, there's an initiative trying to, describe China as the non-market policy and also measures that have hurt the G7 economic interest. But actually, this such an announcement or such a description has not been even entered the voting period because both France and German financial minister object to this such a description and communicate. So I would say it's not one side like every consensus among the G7 yet. So how to treat China and how to balance between the Russian influence and also try to get out of the Russian-Ukraine war. Still have to dialogue with China, still have to involve China in this whole process. So I would say, we have to see how these new measures to implement and also how the measure will evolve, because Europe and France want to take a more independent approach compared to U.S. stance. So, yeah, we'll have to see.
Okay. Well, Yanan, thank you very much indeed for talking to me this morning. Very interesting discussion.
Thank you, Peter.
That's Yanan Wu, who is the chairman and CEO of Surfin Group, which is headquartered down in Singapore.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, chairman of the Asia CEO Forum at IMA Asia, John Schofield, who's managing director of Tempest Investments, and from Washington, D.C., our US economics correspondent, writer and broadcaster Barry Woods. See you tomorrow.
Money Talk